Imagine a snowball the size of a pebble. On a flat surface, it's nothing, but place it at the top of a long, pristine alpine slope and give it a push. As it rolls, its surface area expands, grabbing more snow with every single revolution. What starts as a slow, almost imperceptible drift, historical growth of the S&P 500 since 1957. For American investors, this index is the slope. By holding a fractional stake in the country's largest companies, the broader market has historically provided the gravitational pull for that snowball, delivering an average annual return of roughly 10%. To see what that 10% actually does to your money, look at these intervals. There's a mathematical heuristic called the Rule of 72. If you divide 72 by your expected growth rate, in this case 10, you get the exact number of years it takes for your invested capital to double. Here, it happens every 7.2 years. Of course, zooming in on the chart reveals a terrifying picture. Between 2000 and 2022, the market suffered brutal drawdowns, erasing trillions in value and inciting mass panic on trading floors. But zooming back out on the chart reveals the broader truth. Those short-term collapses generate loud headlines, but they are ultimately noise. Staying on the slope, completely uninterrupted, is what actually generates wealth. There's a popular idea online that saving a simple $100 a month will safely make you a millionaire by retirement. The math simply does not support it. At realistic market returns, 40 years of a $100 monthly deposit lands you closer to $250,000. To reach 7 figures, your absolute contributions have to scale up as your income grows. This area chart compares two distant timelines to show why when you start matters far more than how much you start with. On the left, we have an investor who begins at age 31, steadily putting away $3,000 every year. On the right, an investor waits until age 36, then panic saves a massive $30,000 over 3 years, never adding another dime. Watch what happens as the timeline stretches to age 65. The steady, early savers portfolio rapidly scales to nearly $900,000. The late investor, despite front-loading heavy capital early on, stalls out at $477,000. Waiting just 5 years to start the snowball cost the second investor over $400,000 in terminal wealth. You simply cannot buy back lost decades of compounding. If the formulas are this accessible and the historical returns are this consistent, why do a vast majority of Americans reach their 60s completely stressed about money? The antagonist in this story is a deeply ingrained cognitive bias known as hyperbolic discounting. We're biologically wired to prioritize small, immediate rewards over massive, abstract future ones. Economists call the result dynamic inconsistency. You can sit down on a Monday and rationally plan to invest a portion of your Friday paycheck, but when Friday actually arrives, the present distorts your logic. You suddenly prefer the tangible satisfaction of an expensive dinner out over the distant, invisible security of a retirement account. Recent national survey data shows the scale of this friction. 77% of Americans state they actively want to save, but 63% admit they consistently fall short, specifically pointing to immediate gratification spending as the reason why. Arriving at retirement empty-handed is not a failure of mathematical comprehension. Saving money requires actively overriding your own biological default settings. To see exactly what happens when human biology collides with the American economy, we can look at the Federal Reserve's Triennial Survey of Consumer Finances. This bar chart visualizes the stark reality of net worth for Americans aged 65 to 74. On one side, the average net worth is pulled upward to an impressive $1.7 million by a small fraction of extremely wealthy households. But the median, the exact middle point of the population, sits much lower, at just over $400,000. For the typical family, the bulk of that net worth isn't held in liquid cash. It is locked inside defined contribution retirement plans like 401ks and IRAs. The problem is that access to these employer-sponsored plans is highly uneven, driving a persistent and expanding wealth gap across different racial and income demographics. But for those inside the system, the architecture of the modern 401k offers a massive behavioral advantage. Vanguard data highlights the contribution effect. When the market tanks and portfolio values drop, Those bi-weekly automated deductions continue pulling from your paycheck, forcing you to buy shares at lower and lower prices. By masking the emotional pain of a market crash with continuous new deposits, the system effectively acts as a psychological safety net, preventing investors from giving in to panic and selling at the absolute bottom. To prove that you don't need a Wall Street salary to execute this math, look at the life of Ronald James Reed. He spent his career working in modest environments, like this Vermont gas station, later sweeping floors as a retail janitor. Reed lived an exceptionally frugal life. He drove a battered second-hand car and insulated himself entirely from lifestyle inflation. He found his satisfaction in accumulating capital rather than consuming it, successfully short-circuiting his brain's desire for immediate gratification. He deployed his meager free cash flow into high-quality, dividend-paying companies. He read financial news daily, not to frantically trade on the latest headlines, but to patiently hold those shares and reinvest every single dividend back into the principal. When Reed passed away at the age of 92, his community assumed he had nothing. Instead, they discovered he had quietly amassed a secret fortune of nearly $8 million. He proved that combining modest capital with absolute immovable patience mathematically guarantees wealth. We cannot all rely on the extreme willpower of a frugal janitor to overcome our biological urges. To ensure your snowball actually grows, you have to build structural choice architecture that automates the process. One of the most effective tools is automatic escalation. By setting your savings rate to automatically increase by 1% every year, ideally timed with your annual raise, you increase your contributions over time without ever feeling a psychological loss in your take-home pay. Next, remove the anxiety of portfolio management by outsourcing the complex math. Target date funds automatically shift your investments from aggressive growth to conservative preservation as you age. Couple that with the tax-free growth of an IRA or a company match, and you eliminate nearly all the human friction from investing. The accumulation of serious capital is rarely an overnight spectacle. It is a slow, silent, and highly automated process. If you can protect your portfolio from your own impatience, that tiny initial pebble will inevitably become unstoppable momentum.